September 2008. Lehman Brothers, a 158-year-old financial institution, vanishes overnight. $600 billion evaporates, sending a shockwave of panic across trading floors. The damage bled out immediately. Retirement accounts drained, companies slashed millions of jobs, and the global economy slammed directly into the Great Recession. To understand why, we have to look back to the early 2000s. Interest rates hit zero, borrowing became essentially free, and an entire culture became obsessed with buying houses, regardless of their actual income. Lenders abandoned basic risk assessments, eagerly handing out ninja loans, mortgages designed specifically for people with no income, no job, and no assets. Wall Street took these highly volatile, toxic loans and packed tightly together into complex financial instruments known as collateralized debt obligations, or CDOs. The ratings agencies, paid by the very banks they were evaluating, took these bundles of unstable debt and stamped them with AAA safety ratings, labeling junk as a secure investment. The global economy was resting on a Jenga tower of bad mortgages, hidden risk, and outright fraud. With the foundations compromised, the entire system was primed for a total failure. When that tower finally fell, the pain was strictly one-sided. The government handed Wall Street a massive $700 billion bailout to catch the failing banks, while the executives who built the toxic assets kept their bonuses. On Main Street, the reality was different. Everyday families were left entirely on their own, holding underwater mortgages on homes they could no longer afford. 8 million jobs disappeared. Unemployment hit 10%. $19 trillion in household wealth vaporized in real time. The damage went far beyond lost capital. For many, it represented a total collapse of societal trust, teaching a generation that the system protects the powerful and wrecks the individual. Traditional economics treats us like calculators, assuming every decision is a rational move to maximize utility. But the 2008 crisis forced a shift in that thinking, revealing how deeply our financial choices are shaped by the emotional weight of our experiences. This chart illustrates a behavioral concept called loss aversion. Notice the steep drop on the graph. The psychological pain we feel from losing $100 is vastly more intense than the satisfaction we get from gaining that exact same amount. For many, the 2008 crash hardwired this intense fear of loss, leaving an entire generation skeptical of the stock market. Today, that fear manifests as a desperate urge to constantly time the market. People jump in and out, hoping to dodge a repeat of history. By letting past trauma dictate their choices, everyday investors sit on the sidelines, miss out on decades of growth, and ironically guarantee the very financial failure they're trying to avoid. Bad news naturally grabs our attention. Pessimism sounds like urgent, protective wisdom, while optimism often comes across as a naive sales pitch. Living through the Great Recession trained people to expect doomsday scenarios. Now, any negative financial headline triggers a hyper-reactive panic. Look at this chart mapping the stock market over a single year. You see these jagged, chaotic short-term drops. Pessimists view these drops as a fine, a punishment for doing something wrong, rather than a standard fee for participating in the market. But as this exact chart zooms out to a 100-year timeline, those chaotic short-term drops shrink to nearly nothing against the market's consistent long-term trajectory. Treating normal market volatility as a catastrophic crisis traps people in a comforting fiction of safety, which actually ensures long-term financial stagnation. The next economic shock will not look like the last one. Predicting the exact timing of a market crash is impossible. The most effective defense is building a margin of safety. This is simply the financial gap between your ego, your visible lifestyle, and your actual income. This graphic highlights the difference between looking rich and being wealthy. Looking rich relies on visible luxuries to impress others. True wealth is often invisible. It is the unspent money and the emergency funds sitting quietly in the background. Keeping your living expenses below your means creates options. It buys you the flexibility to wait out a bad market, pivot to a new career, or walk away from a hostile situation. That invisible cushion is the only reliable shield you have. It prevents you from panic selling your assets when the global economy inevitably stumbles. You also have to know exactly what game you are playing. If you copy the rapid-fire moves of a day trader, you inherit their risks without sharing their timeline. True financial defense requires intentional asset allocation. You spread your investments across different asset classes, tailoring your risk entirely to your own long-term objectives. True wealth has little to do with what you can buy. Instead, it's about having total control over your own time and choices. Acknowledging the deep scars left by 2008 is the first step. By unlearning our hardwired loss aversion and choosing disciplined resilience over fear, we can reclaim our financial psychology and achieve lasting peace of mind.